So friends, new chapter that is called as alternate minimum tax. Alright, it's also called as AMT on all persons claiming profit linked deductions other than companies. So AMT is the new chapter which is from section 115 JC to JF. So let's understand what exactly is this alternate minimum taxes. So I want all of you to be very attentive here. So listen, this alternate minimum taxes is applicable for all assessees other than companies if they have claimed any of these three deductions. Listen, AMT shall be applicable to every assessees other than companies if they have claimed any of the following deductions. For companies, AMT is not applicable. Why? Because they have another concept called MAT, that is minimum alternative taxes. It is not there. For the time being, focus on AMT. Listen, so for an assessee, if he is other than a company and have claimed any deduction under chapter 6A C heading, if you are an assessee other than a company, that means individual HUF, AOP, BUI, AJP, LLP, whatever it is, you have claimed that chapter 6A C heading deduction, then you are supposed to follow the concept of AMT. Listen, so what next? Say, or you have claimed any 10AA exemption. What is 10AA exemption? An exemption for those units which is situated in special economic zone. And the exemption is for the export profit that they earn. And it is for the 15 years from the commencement of their activities. For the first 5 years, 100% of the export profit. Next 5 years, 50% of the export profit. And for the last 5 years, 50% of export profit or amount transferred to special cess reinvestment reserve account, whichever is lower. That we will cover at the end of this chapter. Alright, listen. Or has claimed any 35 AD deduction. You tell me what is 35 AD deduction. Say you are a specified business, then for the capital expenditure other than expenditure for land, goodwill and financial instrument, you can claim 100% deduction under 35 AD. Hope you remember that. Now, if you have claimed any of this, plus you are an assessee other than a company, then you are supposed to compute alternate minimum taxes. Now listen, what is this alternate minimum tax? Department say you are an eligible assessee, that means other than company, plus you have claimed any of these deductions, then the tax liability shall be either tax payable as per normal provisions of the Act. Tax payable as per normal provisions of the Act. What do you mean by tax payable as per normal provisions of the Act? You compute the gross total income, then claim all the chapter 6A reduction, then you compute your total income, apply it on the slab rate, plus surcharge if any, plus cess. The normal provision, that is the tax payable as per the normal provisions of the Act. Or you must compute 18.5% of your adjusted total income, whichever is 18.5% plus surcharge if any, plus cess. Alright, whichever is higher shall be the alternate minimum tax liability. Say for example, for you, your tax payable as per normal provision is, say for example, it is 10 lakh and 18.5% of the adjusted total income plus surcharge plus cess coming is 12 lakh. Then which one to pay? 12 lakh is the final tax liability that you are supposed to pay if you have claimed any 10AA exemption or 35 AD deduction or chapter 6A C heading deduction. Which all are the chapter 6A C heading deduction? For you, 80 QQB, RRB, 80 JJAA are the three chapter 6A deductions. So it starts from 80 IA, ends with 80 RRB, not 80 C, 80 D and all. 80 C and 80 D are normal chapter 6A deduction. C heading starts with 80 IA onwards. Now, Listen, if you have claimed any of this and you are an assessee other than a company, then the final tax liability shall be either tax payable as per normal provisions of the act or 18.5% of the adjusted total income, which is subjected to surcharge as well as cess, whichever is higher. Now listen, the question is, what is this adjusted total income? Now friends, let's understand how to compute the adjusted total income. So adjusted total income simply means, we can write it, adjusted total income. For computing adjusted total income, you take the normal total income. You compute your normal total income. What do you mean by normal total income? Computed as per the normal provisions of the act. And in the normal total income, if you have claimed any 10AA exemption, you add back that 10AA exemption if you have claimed any. To the adjusted total income, if you have claimed any 10AA exemption, you need to add back that particular 10AA exemption. Or if you have claimed any chapter 6A C heading deduction, chapter 6A C heading deduction, you add back that particular chapter 6A C heading deduction. Or if you have claimed any deduction under section 35AD, before adding it back, reduce notional depreciation, then only add net back to the total income. And how much is the final figure coming? That is said to be what? Adjusted total income. Now there is a problem. What do you mean by this notional depreciation? Net of notional depreciation. What do you mean by 35AD net of notional depreciation? I'll give you an example for this. Listen. Say for example, say I'm a hospital. I am a hospital with 100 patient beds. I'm a hospital with 100 patient beds. Then I am an eligible specified business. Yes or no? I have built a building. I have constructed a building for 10 lakhs. I have constructed a building for 10 lakhs in year 1. Are you all with me? I have constructed a building in year 1 for 10 lakhs. Then as you all know, I can claim this entire 10 lakhs straight away as a deduction. In the year 1, my profit before 35AD. Profit before 35AD deduction. Before 35AD deduction was say 25 lakhs. Profit before 35AD deduction was how much, friends? 25 lakhs. Then I need to compute 35AD deduction, that is 10 lakh. I can claim 35AD deduction from this 25 lakhs profit, and the remaining 15 lakh will be my total income. I need to compute this by applying, I need to compute the tax liability. Compute the tax liability on this by applying the slab rate. Can you just help me in the slab rates? You put it in the old slab rate and tell me how much will be the tax liability including cess. So the figure will be 2,73,000 is the basic tax plus cess by putting the old slab rates. What else? Listen, normally this is the final tax liability. Yes or no? But department say, if you are an assessee, say I am a sole proprietor, say I am a sole proprietor hospital. Alright, I am an assessee other than a company and I have claimed 35AD deduction as well. Then I have to compute my adjusted total income as well. How to compute the adjusted total income? Listen, to compute the adjusted total income in this example, I need to take the normal total income. How much is the normal total income here? Normal total income in this is 15 lakhs. Yes or no? Yes or no? Normal total income is the 15 lakh. Then I need to add back 35AD deduction. How much is the 35AD deduction that I claimed? 10 lakhs. But before adding back that 10 lakh 35AD deduction, what department say is, what do you mean by adding back 35AD deduction? It is just like you are not taking the deduction under 35AD. If you are not taking a deduction under 35AD, then you could have claimed a depreciation at 10% according to section 32 of Income Tax Act. Yes or no? If you are not claiming 35AD, then you could have taken a depreciation under section 32 for a building. The rate is 10%. So what we can do is, we can net off that notional depreciation for a year. Notional depreciation for a year, that is 10% of this 10 lakh, and that will be 1 lakh. Only the remaining 9 lakh is supposed to be added to the normal total income to compute the adjusted total income. This is what the department say. So adjusted total income, the figure will be how much, friends? 24 lakh. This is the adjusted total income. Now I need to apply 18.5% on this 24 lakh. You tell me how much is 18.5% on this 24 lakh. That is the basic tax liability under AMT. 4 lakh, 44,000, 44,000. Now cess at 4%. How much is cess at 4%, friends? 17,760. Adding these two together, how much will be my liability? 61,760 will be my tax liability. Now let's compare. When I applied normal slab rates on 15 lakh, my tax liability was 273. But 18.5% of my adjusted total income plus cess become 461,760. Now you tell me which one to pay. 4,61,760 is the final tax liability because that is the higher figure. This is what is called as AMT, applicable for any person other than company if they have claimed either 10AA, Chapter 6AC heading or 35AD. They need to compute the adjusted total income. How to compute adjusted total income? Take the normal total income and add back 10AA or add back Chapter 6AC heading, add back 35AD, but you can deduct 1 year notional depreciation when you add back. That 18.5% on that plus surcharge if any. How do you check whether there is surcharge or not? Depends upon the adjusted total income. If adjusted total income of an individual exceeds 50 lakh, 10%. If the adjusted total income of an individual exceeds 1 crore, 15%. Exceeds 2 crore, 25. Exceeds 5 crore, 37. Depends upon adjusted total income, you decide whether there is surcharge or not. Surcharge is there, then on that 18.5% basic tax, you apply the surcharge. Cess always have to be applied. Then compare the both figures and you pay the higher amount as the final tax liability. I hope it is clear. Now friends, there are a few more points in relation to this adjusted total income. Let's understand what exactly is this. Next is a threshold limit applicable for individual HUF, AOP, BOI, AJP. So what they are saying is, if the adjusted total income figure of an individual HUF, AOP, BOI or AJP does not exceed 20 lakh, then forget about AMT. If adjusted total income of either individual, then HUF, AOP, BOI, AJP does not exceed how much? 20 lakh. That means the adjusted total income when you compute it for an individual HUF, AOP, BOI, AJP is less than or equal to 20 lakh. You don't have to compute AMT. No AMT liability. But for partnership firms and LLP, this threshold is not applicable. This threshold is applicable only for whom? Only for individual HUF, AOP, BOI, AJP. I hope it is clear. For partnership firms and LLPs, this threshold is not applicable. This is only applicable for individual HUF, AOP, BOI, AJP. If their adjusted total income does not exceed how much? 20 lakhs, they don't have to think about AMT liability. I hope it is clear. Now listen, there is one more point, that is, if you are a cooperative society, then your AMT liability shall be 15% instead of 18.5%. Assessee being a cooperative society, your adjusted total income's 15% shall be the basic tax liability under alternate minimum taxes. That is actually a new amendment, came as a part of Feb 2022 annual budget. I hope this much is clear. Now friends, listen. In the last example that we have discussed, how much was the normal tax liability? How much was the normal tax liability in the last example that we have discussed? 2,73,000. How much was the AMT liability? 4,61,760. So which one is the final tax which we are required to be paid? 461,760. So here we can say normal tax liability was only 2,73,000 and AMT liability was 461. Now we can say AMT liability is comparatively higher to the normal tax liability. Yes or no? That excess that you have paid on account of AMT is called as what? AMT credit. AMT credit shall be 4,61,760 minus 2,73,000. That excess you have paid is called as what? AMT credit. AMT credit. Now tell me how much is the AMT credit in this example? 1,88,760 rupees is your AMT credit. You can carry forward this AMT credit to how many years? To subsequent 15 years. This is what the department say. If you have AMT credit, you can carry forward that credit to subsequent 15 years. Now, how do you set off this AMT credit? Let's see. Let's understand how to set off this AMT credit. Listen, say this is year 1. This is year 1. I have carried forward 188,760 as the AMT credit. For the easiness of example, I am rounding this figure. and I am making it 2 lakh. In examination, you are not supposed to do any round off. To simplify the example, I am rounding this 188,760 to how much? 2 lakh. Only for making the example simple. Okay. Now, in examination, in the problem, please don't do any round off and all. Now listen. So 2 lakh is the AMT credit that we are carry forwarding. Now in year 2, say the normal provision or tax liability as per normal provision is say 1 lakh. Tax liability as per normal provision is say not 1 lakh, say 5 lakh. Tax liability as per normal provision is say how much? 5 lakh. Now your AMT liability, that means tax payable as per this alternate minimum tax liability, say it is 4 lakh. Say it is 4 lakh. Now you tell me which one to pay as the final tax liability. Whichever is higher. That means 5 lakh should be paid as the final tax liability. So in the year 1, AMT was high. In year 2, AMT is less. Yes or no? Year 1, AMT was high. That's why you get an AMT credit. In year 2, situation reversed. That means normal is high and AMT is less. So in year 2, what you can do is, anyways you have to pay this minimum for. You can take 1 lakh from this brought forward AMT credit and you can claim it as a deduction. You can claim 1 lakh from the brought forward AMT credit and you can claim that as a deduction. You don't have to pay 5 lakh in year 2. You're only supposed to pay how much? 4 lakh. Are you with me? Instead of 4 lakh, say the AMT credit is, instead of 4 lakh, say the AMT credit is, say 3 lakh. AMT credit is how much? 3 lakh. Then what to do? You claim 2 lakh from the brought forward AMT credit. Not AMT credit. Say year 2, the AMT liability is 3 lakh. Then you take 2 lakh, the entire AMT credit and claim it as a adjustment. And you must pay how much? 3 lakh as the tax liability. Or say for example, another example, say my AMT liability in year 2 is only 1 lakh. AMT liability is year 2 is only how much? 1 lakh. Now 5 lakh was the normal tax payable, but I don't have what? Enough AMT credit. In such situation, what I can do is, I can set off maximum 2 lakh from this. The remaining 3 lakh I must make the payment. I must pay remaining 3 lakh anyways because I don't have 4 lakh AMT credit to set off. So the point is, friends, in a year, if your AMT liability is high and normal tax liability is less, then you are supposed to pay something more due to the AMT provision. At that something more can be claimed as the AMT credit in future. How many years you can carry forward it? To subsequent 15 years. Say in the subsequent year, your AMT liability is less. Normal tax liability is more. Year 1, it was just the reverse. Year 1, AMT was high, normal was less. Year 2, what happened is, normal is high and AMT is less. That difference amount, you can adjust it from the AMT credit if you have adequate AMT credit. That means in year 2, minimum AMT you have to pay. If you have the difference amount as the AMT credit, then you can set off. Hope you remember the 3 examples which we have discussed. Are you with me? Say in year 2 also, your AMT liability is high and normal is less. Then what to do? Again, the difference can be claimed as AMT credit for another 15 years. Maximum up to 15 years you can claim. Even after 15 years, you are not supposed to claim it, then gone. After 15 years, the AMT credit will automatically expire. You cannot claim it as a deduction after 15 years. I hope it is clear. So this is the concept of alternate minimum tax liability which is applicable for any assessee other than individual HUF, any assessee other than company which claims 10AA, Chapter 6A C heading or 35 AD. I hope this much is clear. So friends, the next point is, if you have opted for 115 BAC, you don't have to pay AMT. Hope you remember. If you have opted for 115 BAC, what is 115 BAC? The parallel slab rate applicable for individuals. If you opted that, you don't have to worry about AMT liability, because AMT liability is not applicable for you. That's what the department say. Now friends, before we move on, let's understand what is this 10AA exemption. Because along with the AMT, normally they mix 10AA exemption as well. So let's understand what exactly is this 10AA exemption. So, tax holiday for units established in special economic zones under section 10AA. So please listen. So friends, coming back to the point, the exemption in cess entities or exemption for cess entities. So the first point is, if you started your manufacturing or provision of services on or before 31st March 2020 only, you are eligible for 10AA exemption. So to claim 10AA exemption, you need to start your manufacturing activity on or before 31st March 2020. You start your manufacturing activity today, you are not eligible for exemption under 10AA. You need to start it on or before 31st March 2020. But 31st March 2020, we had a problem. What is that problem? Corona was here, right? So department, what they are saying is, if all your sanctions, everything is ready before 31st March 2020, but you started your business on or before 31st March 2021. That means your sanctions, papers, everything is ready on or before 31st March 2020, but you haven't started your business. You are starting it on or before 31st March 2021. In that case also, you are eligible for a 10AA exemption. Are you with me? So, if your sanctions, papers, approval, everything is ready before 31st March 2020 and you have started your business on or before 31st March 2021, then also you are eligible for 10AA exemption. Now the question is, what is this 10AA exemption? How do you claim this 10AA exemption? For that, there is a table we have to study. That is the quantum of deduction. So let's understand, how do you claim this 10AA exemption? So listen, for the first 5 years, say you have commenced your activities, for the first 5 years of operation, how do you compute your profits? Listen, first you need to take the entire profits of the undertaking which is in cess. First you compute the entire profit according to the normal provisions of income tax. You compute the total profit. Then multiplied by the export turnover and divided by the total turnover. That amount will be the exemption under section 10AA. Say for example, this proportion or this fraction means if you are doing only export activity, entire profits will be exempted. If you are doing some domestic area activities also along with the export activities, only those proportionate profit which is from export activity is eligible for exemption under 10AA. Are you with me? If you are doing only export activity, then that entire profit will be fully exempted. But if you are doing some domestic operations also along with export activity, then only those proportionate export activity profits alone shall be exempted. And this exemption shall be 100% for the first 5 years. Year 1, 2, 3, 4, 5, 100% of the profit, export profit shall be your exemption. Are you all with me? Now, for the next 5 years, what is next 5 years? 6, 7, 8, 9, 10. For the next 5 years, you take 50% of the equation. What is the equation? Profit of the undertaking into export turnover divided by total turnover. That amounts 50% you claim as an exemption. Then for the next 5 years means 11, 12, 13, 14, 15. Either 50% of the fraction, provided such profit must be credited in reserve account called cess reinvestment allowance reserve account. That much amount, whichever is lower. That simply means either the amount deposited in cess reinvestment reserve account or 50% of the profits, whichever is lower, shall be your exemption for the last 5 years. I hope it is clear. Now friends, before we close our explanation, there is one thing. What do you mean by export turnover? Now friends, listen. In common layman's language, what do you mean by export turnover? So in a common layman's language, export turnover simply means whatever you sold outside India or whatever services that you provided outside India is said to be the export turnover. But 10AA, it is different. Departments say, if you are providing something outside India, then the consideration should be received in India or it should be brought into India. Then only we will consider it as an export turnover. Say you are selling outside India. Then you have to bring in that consideration into India or you must receive that consideration in India. Then only we will consider it as an export turnover. Otherwise, we will not consider it as an export turnover. Now you tell me, why are we giving a 10AA exemption? See, to promote the exports. If the exports, if we are promoting the exports, then what will happen? More foreign currency will be here. Then we don't have to buy that foreign currency in India. If you don't have to buy the foreign currency in India, our rupee will gain. Normal demand supply theory. Yes or no? So what department say is, you do an export, it's okay. You have to bring that fund for Indian economy to get the benefit. So what they are saying is, if you want us to treat your export sale as an export turnover, then you must either receive the income in India or you must receive that particular amount in back to India. Then only we will treat it as an export turnover. Now, it does not include three items: the freight, telecommunication charges, or insurance payment, which is attributable to the delivery of articles or things outside India, or any expenses incurred in foreign exchange in rendering of services outside India. Say normally, when we raise an export bill, it may be at CIF value. What is CIF value? Cost plus insurance plus freight. Yes or no? Say, cost of the good is 10 lakh. The freight charges is, say, 1 lakh. And the, insurance charges, say, 50,000. So, how much is the total bill value? 11 lakh 50,000. Yes or no? Can you call this entire 11 lakh? Say, I'm raising my bill like this. I'm raising my bill like this. Now the question is, can I call this entire 11 lakh 50,000 as my export turnover? No. This freight, you will give it to the shipping company. This insurance, you will give it to the insurance company. So how much is your turnover? Only 10 lakh. So that's what they are saying. Even if your bill is in CIF, that means cost including insurance, freight and telecommunication charges, whatever it is, then you need to remove those elements from the export turnover because it is not your sales turnover. So you need to remove either freight or telecommunication charges and insurance and any other expenses incurred in foreign exchange for rendering a services outside India. Say for example, overseas installation charges. You are charging something in the bill for the overseas installation also. That also have to be excluded from the export turnover. Are you all with me? Are you all with me? So when you compute the export turnover, you remove what? Freight, telecommunication charges, insurance and overseas expenses that you have incurred in foreign currency outside India. That's what is called overseas expenses. Now there is one more thing. From your total turnover also, you can remove this. From your total turnover also, you can remove these four items. Otherwise, it will get imbalanced. Otherwise, it will be illogical. While you compute your total turnover also, you can remove all these four items for the purpose of computing 10AA exemption. I hope it is clear.
To purchase recorded lectures and textbooks, visit our website www.cajoscurian.com.